Welcome to the 8th episode of Made in India, a podcast that dives deep into various Indian businesses, uncovering their fascinating stories and insights for business enthusiasts like you. In this episode, we are excited to discuss IIRM Holdings India Limited, a company operating in the insurance broking space across multiple emerging markets, including India, Singapore, Kenya, and others. As of today, India is the key market for the company, where it operates under the brand name India Insure. To discuss this business with us today, we have the visionary himself, Mr. V. Ramakrishna, the founder and the promoter of IIRM Holdings India Limited. Ramakrishna sir is a chartered accountant and a veteran in the Indian insurance broking industry. He has played an instrumental role in licensing insurance broking in India. Additionally, he has also served as a director of the Insurance Brokers Association of India for 2 years. Currently, he is actively pursuing his dream of expanding India Insure's business to other geographies by establishing insurance broking operation in multiple countries. In this episode, we discuss IIRM Holdings' journey, the insurance broking opportunity that India and other emerging market presents, and various other nuances about the insurance broking business that is unknown to outsiders like us. So sit back and immerse yourself in this insightful conversation covering the business of IIRM Holdings on Made in India, powered by Bastion Research.
First of all, very warm welcome, Ramakrishna sir.
Thank you
Thank
so
you
much.
so much. Thank you so much for agreeing to do this podcast and being a part of our show Made in India. We look forward to have a insightful and fruitful conversation with you, and expecting to learn a lot regarding the business of IIRM Holdings India as well as the industry in general. So very warm welcome to the platform, sir.
Thank you so much for asking me to join your platform, and I hope I can do justice to your expectations.
We have no doubts there. Before getting on to the questions, sir, I would just like to provide a standard disclaimer. All the viewers be informed that Bastion Research is a SEBI registered research analyst, and all the views that any of the guest or the host express on this podcast are solely their own and should not be relied upon as a basis for making an investment decision. In case you decide to act on any of the information that is provided in the podcast, we strongly recommend you to consult your financial advisor and do proper due diligence before taking any action. Any company which is discussed in this podcast, or any business which is being talked about on this podcast, is purely for an exploration and education purpose. There is no intention behind providing any sort of investment advice here. So with that disclaimer, sir, I would like to ask the first question.
Yeah.
So, sir, before getting on to the business, etc., I would like you to give us a broad overview of the industry. Like, how is the insurance industry structured in India? What is the size? What are the various segments in which one can divide the insurance industry to understand better, right? What kind of players dominate the industry? Is it, more government focused still, or private players are coming up? So I want you to give us some brief information which I just mentioned, and have an industry overview from this.
Sure. The insurance industry, of course, has been a pretty old industry as far as India is concerned, and there have been a lot of developments in the last 25 years as far as the insurance sector is concerned. Prior to 2000 or 1999, to be precise, the insurance industry consisted purely of government-owned players, which was the Life Insurance Corporation of India, and you had four companies on the non-life side, which was New India, Oriental, United and National Insurance. All five entities were 100% owned by Government of India. And of course, they also have an Agricultural Insurance Corporation of India, which does pure crop insurance. And then there is a separate insurance company for export credit, ECGC, Export Credit Guarantee Corporation of India, which also insures your exports outside the country. So this was the broad landscape when the government, in its desire to liberalize, open up the Indian economy, felt that insurance as a sector also needs to be opened up, and there was potential for huge growth. And the growth in the economy needs growth in the insurance players, capacity, support, technology, etc. And that's why the sector got opened up in 1999, and when the Insurance Amendment Act was amended to allow participation of private players into the Indian market. The foreign players' equity in the insurance sector was restricted at about 26% initially. Slowly, the government has taken steps over the last 25 years to move it from 26 to 51, 51 to 74. Finally, the latest bill that got tabled in Parliament a month back now talks about 100% foreign ownership of insurance companies is also being contemplated, and hopefully once the Parliament approves the bill in another couple of months, you will be allowed to have 100% foreign owned insurance companies also in India. So the sector has a variety of players, and as I mentioned broadly, there are two big categories of the market. One is called life insurance, and other is called non-life insurance. More specifically, the non-life is also called property and casualty insurance. Life insurance companies will insure only your life or your accident purely, whereas non-life companies can insure your property, your vehicles, your valuables, your home, your health insurance, your accident insurance, and a variety of other insurances are covered under the non-life sector. So the segment-wise, one is life, other is non-life. Life, of course, is a far bigger sector of the market because life involves two components. One, life insurance is also used as a saving pool. People keep on paying monthly premiums and they get accumulated, and if you are surviving the policy period, then you get the money back. And there are some insurances where the money doesn't come back, but it insures you for your life. God forbid something happens to your life, your dependents or beneficiaries get the money. So life has those two broad segments. One is money back and other is a pure life cover. And as I mentioned, in the non-life portion, you have a variety of insurances, etc. Broadly, if you were to look at the size of the insurance market at the end of, say, March 24, for which published data is available, the life insurance premium that is paid every year is about 8.3 lakh crores. Whereas on the general insurance side, the premium is close to about 2.86 or 2.9 lakh crores of premium. So this is the broad number that we are talking about. And the overall market is about 11 lakh 20,000 crores is the total size of the insurance premiums that are getting paid every year in our country. Let me also here give you a small clarity. Life insurance policies typically would be long-term policies. That means you keep paying premium year after year and you continue to enjoy the coverage. Of course, if you're buying a pure term life cover, that means only no money is going to come back, only you're covering your life, then that policy is only typically for 1 year. Whereas in the non-life industry, you do not have any long-term policies. Predominantly in non-life, except maybe one or two exceptions, every policy comes up for renewal every 365 days. So that's a big difference between the life industry and the non-life industry. So that, in terms of numbers, is the size of the market that we are talking about. So it's a huge market. But is this enough? You think is it adequate? That is definitely a very big question or a very important question that I think would be of interest to your viewers. From a market size perspective, if you were to look at the global size, India has remained by and large the 10th largest insurance market in the world. So approximately, I would say we are in the region of 130 to 140 billion US dollars, whereas America is at about 3,000 billion dollars. So there is a huge gap between the rest of the world and us. You have the number one being America, number two is China, followed by UK, Japan, France, Germany, South Korea, Canada, Italy are bigger than from a market size perspective. But you will also agree with me, looking at the size of the Indian population, we are the world's number one population. Whereas from an insurance perspective, you are number 10. So, and we have been stuck at number 10 for quite some time. We have not really been able to move the needle beyond the number 10 number. So that gives you an idea that the size or the potential for insurance growth in this country is humongous. It's unbelievable is the number. And that is the reason why you will see there is a beeline of companies wanting to start business in India. Every year you are seeing 3, 4, 5 new insurance companies coming into India because they all sense that there is a huge upside in the Indian industry. India is a growing economy. People are growing. Economy is growing. The risk factors are growing. So the need for insurance is definitely extremely high. Typically, the world uses two parameters to look at insurance scope for expansion or what it should be. One is called the insurance penetration. Insurance penetration typically is the total insurance premium paid in a country divided by the gross domestic product of the country. Our average is at about 4%. 4% of our GDP is the size of our insurance industry. Whereas if you were to compare us with the rest of the world, it's close to about 8%. So when the world average is 8%, we are at half the level from a size of the insurance industry vis-a-vis the GDP. And that's what explains the number 10 position vis-a-vis the third largest economy or the largest populated world in the country in the world. The second parameter that we use is the per capita insurance spend that is happening. Total insurance premium paid, which I just mentioned to you a little while ago, was that 12 lakh crores is getting spent. Divided by our Indian population, it translates to about approximately 9695 US dollars per person. Whereas the world spending is close to 80, our spending is about 95, and the world spending is $900 per person. So which tells you two things. One, how much are we insuring vis-a-vis what we should insure? That is extremely less. Number of people that are buying insurance, etc., is less. And even when we are buying the insurance, the quantum of insurance that we are buying is also far less. So there are two upsides. The overall size we can increase, and the people who are already insured need to insure more. Because typically what happens, people think I'll take a life insurance for 5 lakh, 10 lakh, 15 lakh. Good old days, that was enough. But these days, 15, 20 lakhs gets you nothing. You want to buy a flat in any of the major metros, you're going to spend a crore, crore and a half. You have to borrow loan from the bank to buy a house, to buy a car, to buy your white goods, etc. So any typical employed person today carries fair amount of debt on their heads. And if something happens to the breadwinner, then the EMIs will not get paid. So what's very important today is for people have to really seriously look what is my current lifestyle and what is the kind of money my family would need over the next 15, 20 years till children grow up, become independent of their own, and you have to plan for your own retirement. If something happens, how do you depend? So all that you need to figure that out to buy adequate insurance. So the need to reassess what you are buying is extremely high in the economy today. So that is what I wanted to share with you, saying that the potential for this insurance industry is very, very high. And that's
So
why you see a lot of foreign interest, a lot of foreign investors are flocking into India. They are setting up insurance companies. A lot of private equity companies are funding insurance companies, etc. They are funding insurance intermediaries, etc. So there's a huge growth momentum that is there in this sector at this point of time.
Just to sorry to cut you short, but
Yeah.
considering the potential that you mentioned, it got me into thinking. So it's not like 140 crore of the population that India has is our potential market, right? There is only certain strata of people that can actually afford to buy insurance. It could be 10 or 20 odd crores, or maybe less, more. I'm not sure. So what do you think is the ideal potential market that we should look at? कि अगले 10 साल में, let's say, this is the target market that India needs to achieve in terms of number of people that needs to get insured.
I think it will be very difficult to put a specific number to say how many people you think should be insured or should get insured. But to answer your question, is the addressable market 100%? I agree it can't be 100%. But if you want to ask me, I can say 90% can be done. I'll explain to you. You said insurance affordability. Today, this system, the world has changed. A lot of innovations have happened where you even have a concept of micro insurance. Nothing prevents you from saying pay 2 rupees a day for your life insurance cover. You can have as cheap as 2 rupees a day or 1 rupee a day. Depends on how much you are buying as an insurance. So you want to insure your life for just about 1 lakh of rupees, or you want to insure your life for 5 lakhs of rupees. So you can start from 1 lakh, or you can start from 50,000 and go all the way up to 100 crores to insure your life. So I believe that the potential for everybody exists. And what you have also seen is the government of India has launched a mission saying that insurance for all by 2040. The government is doing everything it can to say that we want every citizen of this country to be insured, maybe for health, maybe for accident, or maybe for life, or maybe all three put together. So there are a lot of initiatives which the government of India and the respective state governments have taken to reach out to everybody. The government today is covering people under Ayushman Bharat for up to 5 lakhs of rupees below poverty line, and any senior citizens above the age of 70 are also being covered across the board irrespective of their financial strata. Similarly, for farmer insurance is very, very widespread across. A lot of state governments are covering farmers. A lot of state governments are covering unorganized labor also for health insurance and life insurance. So when you have these kind of initiatives where the government is also spending money to get people insured, I don't see why we can't have 90% of the population insured. It's just not the affordability of the individual. The society is also moving in this direction. The government is doing. Every organization, small to medium to large, is insuring their employees, etc. So the government employees are being insured. So you have so many initiatives. So I don't see the argument that the entire population can't afford it. They may not afford it, but somebody is helping bridge the gap.
Perfect. So you have very well explained some of the initial days of the insurance industry, where 1999 the industry got opened up and private players were allowed. See, similarly, what were the key milestones that has evolved in the last 20, 30 years that has shaped up the industry to what it is today, right?
So we must compliment the insurance regulators who have played a very good role in the development of this market over the last 25 years. It's been a very carefully calibrated journey which the regulator has put a roadmap for the country. So initially there were a lot of controls, tight monitoring, etc. that was done. We used to have a concept called tariff. Tariff means the scope of the policy was clearly defined. The pricing structures were defined. the remunerations to the agents, etc., or the distributors were divided. Everything was very defined. So the regulator didn't want to rock the boat. For about 5 6 years, they made sure you had all the players coming in, stabilizing their products, networks, everything, etc. Then the regulator has also been very cautious and careful in bringing in capital adequacy. They did not want any fly-by-night operators coming in, picking up money from the public and going bust, etc. So there have been very, very stringent norms on the amount of capital that you need to start insurance business. They have done a lot of diligence on who the promoters of these insurance companies are, whether they have track record, their credibility, because you are playing with the savings of the people. And that too, these savings are for a bad day or a contingency, which is what that worries them. So you need to be extremely careful and cautious in making sure the right set of people get into this sector. So that has been a very calibrated, filtered approach. Yes, today you have a large number of players. We have 50, 60 insurance companies, but all have been very carefully vetted by the regulator. So they have ensured the stability of the sector. Slowly, slowly, they opened up the rules and regulations. They didn't do it in one go. They have seen the progress of the industry. They have seen the size of the industry growing. The maturity has come into the marketplace. The conduct of business has matured. So all these things have finally given the comfort to the regulator. So they are now moving into a new phase where they are saying, hey, you guys should do self-regulation. The initial journey is over. Fairly good foundations have been laid down. You run your operations the way you want. These are the broad frameworks that they have put. So they have now opened up the type of policies you can issue. They have opened up the pricing also, which has been left free to each insurance company to decide how they want to price their product, what they want to sell, where they want to sell, how they want to sell. Everything is now being pretty open and living. But they are controlling the amount of capital that is required in the business. They're checking the solvency of the insurance companies, etc. They're conducting periodic inspections of the various entities in the industry to make sure the rules and regulations are being followed and adhered to. So the regulator has taken a very judicious, calibrated approach, which has brought in stability into the insurance. Just to give you the complexities involved, to tell you the number of players that are there in the market is the number of distributors is crazy. You have close to 1 lakh micro agents who are distributing. You have 49 lakhs of individual agents. You have 21 lakhs point of sale persons. You have 635 corporate agents, 29 web aggregators, 683 insurance brokers. So this is the size of the people who are involved in this distribution, and regulating so many people, keeping tab on what is happening is a gigantic task. But I think the regulator has done a wonderful job. They have kept good control, making sure that things are done the way policyholders' interests are being protected. They do not get affected, etc. So that the promises made at the time of sale are being adhered. You have a good insurance grievance redressal mechanism. You have ombudsman being put in every state. Consumer forums are there. So all these mechanisms have been put so that the consumer's interest is always paramount and policyholder gets the benefit of what he is buying when he pays the premium. So that has been what the regulatory landscape in this country has been. And now the regulator is focusing on widening the distribution network, how we can penetrate to more and more people in the country to have access. The regulator have been pushing the insurance companies to do innovations, bring in new products, customize products to local needs, etc. Don't try to sell one size fits all across the country. Make it region specific, territory specific, segment specific, etc. So there's a lot of depth that is now getting created in the insurance industry.
Sir, I also have a follow-up question to the answer which you just gave. So
Yeah.
you said that there is a lot of effort which the government has been putting over the years to open up the sector. And when you open up the sector, obviously, a lot of private, companies come in, which has been the case. So, sir, can you tell us what is the, market, both in life as well as non-life? What is the market which is still controlled by the government entities, and what is the percentage market which is controlled by private entities combined? And how is the progression sort of moving? Can we see something which we have seen in banks, where government sector banks have, ceded market share to private sector banks? Can we see something of that sort happening in the insurance space as well?
Yeah, absolutely. It is identical. I think it is nothing to do with any sector, if I might say, whether it is banking, whether it is insurance or any other sector. For example, even aviation, for example, when we had only Air India and nobody else, the public sector had 100% market share. With the entry of private, you will see the distribution. The answer is the size of the market has grown tremendously in the last 25 years. The CAGR that you have seen of the insurance industry in India is close to about, how much I should say, about 14% CAGR. So 14% growth cannot be handled by a few companies. That kind of a CAGR that over the last 20 years, if you have seen, you need to bring in more players into the market. The more players have come in. Yes, the government companies' share of the pie has come down, whether it is Life Insurance Corporation or whether it is the four state-owned companies in the non-life sector, definitely the shares have definitely come down. In fact, the shares have come down below 50% now of the public sector. Private sector has taken over more than 50% in the non-life sector. In the life side, yes, still LIC has maintained its dominant position as the numero uno player and they still control majority of the market. But yes, slowly you will see that it will move towards the private sector. So that is the movement, and I think it's a healthy movement. And end of the day, my point of view, submission to you and to your viewers is, please rest assured, whether it is private or public, your money is safe. If there is an insurance player who is regulated and who's been granted a license, the regulator is making sure that there are enough checks and balances in the system so that the public's money is safeguarded and the promises made to them are fulfilled. So I don't see any distinction between a government owned company or a private company. Like in the banking side, the Reserve Bank of India maintains strict vigil on what is happening. Similar stuff is happening on the insurance side also. So that is definitely been the trend line. Moving away from the government companies is a trend.
Sir, you mentioned 14% CAGR. That is something you mentioned as the industry growth. Now, there are a very few industries, in my humble submission, there are a very few industries of this size growing at such rate, right? So, can you just help us quantify, again, sticking to the public versus private thing, at what rate? I understand the industry is growing at, let's say, 13-14%, you mentioned. How is the private players growing and how are the public players growing? That's one. And secondly, I also want to, pick your brains on the entry barriers which are associated with both these sub-sectors, if I have to say. The entry barriers are significantly high as far as the life insurance companies are concerned. On the flip side, if I look at the non-life insurance space, where you rightly said that there are multiple private equity players or multiple different players backed by strong institutions who are waiting on the sidelines to enter the sector.
Yeah.
So, is this understanding correct, that life insurance has significantly high entry barriers versus non-life? And if that is the case, why is it so, sir?
Okay, to the best of my knowledge, I'm not very conversant with the life industry because that's not been my focus area of business. But from my general understanding, the entry barriers are not dissimilar. They are quite same. The licensing regulations are same. The capital required is the same. So the maybe the reason why you are seeing lesser number of players come into the life side is, life side in my view is, the gestation period for a life insurance business is little longer. You will have to build that brand reputation. You will have to earn the consumer trust because he's parting with 10-year money, 15-year money, 20-year money, 25-year money. That's number one. Second, in the life game, having a very strong financial distribution network is mandatory. So unless you have a banking partner, you have somebody who has massive retail outreach, like a non-banking finance company, etc., it would be very difficult for a brand new player to come and set up their own distribution network of agent, broker, blah, 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 to get going. And if I'm not wrong, most of the banks, both public and private, all the big guys, are already in this business. Whether it is ICICI, whether it is HDFC, whether it is State Bank of India, whether it is Punjab National Bank, Bank of India, Bank of Baroda. And of course, LIC is the giant of all. So when you already have such big companies already penetrating into the market, so when you do a feasibility study, hey, I'm a new player, I want to start a new life insurance company, I think the task is very daunting. And that could be the reason, in my view, why the entrance in the life is lesser. It's not that there is an entry barrier against life. Yes, the vetting process will be far more stringent in a life company to know about the KYC of the promoters, the organization, the business plan, whether they have structured adequate capital to sustain the long-term development. Non-life, since the policies are for 12 months, maybe you may have some claims which may extend to 2, 3, 4, 5 years. It's still a finite period. So the quantum of credibility or the capital base that you require for a non-life would be lesser. So these could be the parameters why you are seeing lesser entries into life than when you compare to non-life. And non-life is a far more easier market to penetrate. You can do a lot more product innovations. There is scope for a lot of niche players, etc. So that is my view of the reason.
Thank you for the detailed answer. So, since India market is growing at almost 13-14%, which is a very healthy growth for the industry of this size and magnitude. So, is the same kind of trend, visible in the other emerging markets like Kenya or Sri Lanka or Maldives or all those emerging markets?
Okay, let me give you clarity there. Those markets have been open markets for a very, very long time.
Yeah.
There is no liberalization like what we saw 25 years ago. They were liberal or open to private sector participation for quite some time. The overall economies in those countries is small. So to the relative to India, they are very tiny. But the trend lines that you are talking about is similar. There also the industry is growing. They are also developing countries, emerging economies. For example, in Kenya also the industry has grown at a CAGR about close to 10 to 12%. Similarly, if you were to look at Sri Lanka also, the CAGR is ranged from 6 to 8%. And in Maldives, it has ranged even much higher, 20% CAGR. Because there's a very tiny economy and the smallest growth will give you a far more accelerated stuff in those markets. So, but the trend line in all emerging economies is only upwards. The gap of insurance is very, very huge. If in India only the density number is $90 versus $900 and penetration is 4 versus 8, these countries it will be far worse. So the upside potential is there in each and every market that you can see on the emerging side or in Asia, definitely. Asia, you will see a huge growth potential. Africa, you will see a growth potential. Latin America, you will see a growth potential. Europe, America, Australia, England, Japan are fairly saturated markets. There you won't see that degree of upside.
Perfect. So coming to the insurance intermediaries. So basically, for any industry to develop, there is one product manufacturer like the insurance companies, but there is also intermediaries like insurance agents or brokers who actually help promote the product, right? To push it to the last mile, basically, right? So what do what role these insurance intermediaries play in the overall development of the insurance market?
Yeah, as you rightly pointed out, intermediary is a very vital link in this whole journey of product conceptualization to the delivery of to the customer. Insurance is definitely a complex instrument or a complex subject, I would say. End of the day, it's a legal agreement between the person who is buying the insurance policy and the person who is selling, which is the insurance company. It's a contract. It's a legal document. So it is very important that you need good, well-educated and knowledgeable distributors who can unravel the complexities of the legal agreement, explain it to the consumer and say, hey, this is what you're buying, this is what you will get covered for, this is what you will not get covered for. Because if you are not very thorough in understanding of the document when you bought it, and you read the document at the time when you need a claim or when you need the insurer to pay you the money, you will get a lot of shocks and surprises because that's not the time to read the document. The document has to be read before you buy the policy. So to expect an ordinary consumer, be it as a retail individual, you, me, or anybody else, or a small and a medium business, that they should be knowledgeable and understand completely the insurance products, nuances, and the legal language is asking too much. So this is the reason why you need distributors who can build the gap in knowledge, in understanding between the consumer and the insurance companies. And that is the function why the distributors are prevalent world over. If you were to look at the global markets, and you'll be surprised, even markets like Africa and Asia, the intermediary channel controls practically 90%, 95% of the business. It is only in India, because we didn't have private players till 25 years ago, the insurance companies were marketing direct, except for the life side where you have agents. Non-life was 100% direct practically. Now the number is slowly come down, where the direct business is down to about 25%. 75% is growing through intermediaries. It will only further drop. Finally, we will also reach about 80, 85 to 90% will go through intermediaries only. Life insurance, because it is to reach out to millions of individual people, has always relied on an agency force. So there the distributors have been extremely strong. Life insurance corporation doesn't sell directly. It can, very small quantum. Bulk of it gets sold through the agents, etc. So that is the fundamental driver for distribution requirements in insurance company and in insurance industry.
It's an interesting trend that you mentioned. Sorry to cut you short, because if I look at the mutual fund industry, the trend is actually on the reverse side, where the direct penetration, direct mutual fund investment is increasing compared to distribution led. So, well, I'm not able to make up my mind why that is happening, why this dichotomy, where at one end where people are becoming more financially aware, financially savvy, where they're able to make a decision regarding the which mutual fund to invest in, but at the same time they're not able to make the investment decision regarding which insurance to go for. So,
There is a very fundamental difference. In a mutual fund, for example, fine, I may not be extremely knowledgeable. I'll try to read the track record, just publish data, how they're doing. Okay, I said they're doing good, they're giving me 7%, 8%, 10% return. I'll put my money. You have the freedom to pull your money out when you want in bulk of the
correct,
case.
correct.
But I can't pull my money out of an insurance policy.
Mm.
You have bought your car insurance today. You can't cancel it midterm. You can cancel it midterm, you lose your premium.
Correct.
Why
It's a
are
heavy
you
lift cost.
cancelling it? And on what basis are you cancelling it? Insurance is only a promise. It's a
Mm.
contingent promise. I promise to take care of your problem. God forbid you have a problem. If you have no problem, you don't even know what my promise was.
Correct.
Understand? Insurance, I'm only giving you an empty promise. I'm taking money for a promise. Whereas mutual fund, I'm not taking for a promise. Mutual fund, I'm saying, hey man, I'm going to take your money. put it into this stock, this industry, this portfolio, this makes blah blah blah. If that industry do well, you can do well. That's a far more simpler risk that an individual is bearing in his mind when he buys a mutual fund. So there, yes, if you are distributing directly, I can understand. But if you're telling me in insurance, it is a contingent promise. When there is a claim, why did the claim happen? You had an accident in your factory. Was it because that you not bothered to maintain your machine? Or was it because of some other reason? Or your neighbor had a problem, so that cascading impact came and affected your factory or your machinery? Or your car has got affected? Did you go and hit somebody? Or somebody hit you? Or this damage was caused today, this damage was caused 6 months ago, and you are claiming all the damages today? So the complexities of an insurance claim are crazy. I can assure you, no two claims are same. No two motor accident claims are same. No two property claims are same. No two health insurance claims can be same. So I may have a cataract operation. I may have got a cataract operation because of a diabetes, which I already had for the last 10 years. Whereas another person genuinely didn't have a diabetic, but he had a cataract. So in one case, it will get paid. In another case, he'll say, sorry, we will not pay you. So the complexities that you will see in an insurance claim is not something which you can tell me, I will go to the World Wide Web, put a comparison, plug in 5 parameters, and bingo, I'm going to buy. Please buy. Buying is easy. Buying is not at all complicated. But when there is a claim, that's when you have the complication. And that day, I'm sorry, a chat GPT can't solve your claim problem. A buying problem will be sorted. But if you have a qualified intermediary, yeah, I'm an intermediary, so I'm pitching for it. So a qualified intermediary can understand your claim, explain it to you, explain it to the insurer, and see if there is the path to get the claim. So that is why, in my view, insurance is a complex piece. It's like simple. Why do we need lawyers? Tell me. The Constitution of India is accessible to you, to me, to anybody. Let's do. Why do we need lawyers? Let me go and present my own case in front of the judge. The case studies are available, the precedents are available, but do you think that will help us become good lawyers and draft ourselves? So similarly, I would say there is complexity in insurance. Yes, there are certain products in insurance which are very simple to understand, very easy to understand. Those will definitely get sold online. For example, term life. Term life is a vanilla product. What it says, you pay me this much money, man, no medical, nothing. I cover you for X amount of money. God forbid you are not surviving. It's a very simple, straightforward policy. There are no complications in that. But you say a money back policy, combination of features, part of the money I'll give you in 5 years, 8 years later, something else will come. I will add this benefit, subtract this benefit. It complicates the matter. There you need an advisor. Similarly, you have maybe a vanilla product for car insurance. Sorry, I will only cover these 4 things on your car. 5th item is not covered. Yes, that can potentially be sold online. And that is why you see a lot of traction happening on the online side. Similarly, health products are also getting sold online. A lot of health insurance is getting sold online. Yes, products are being made simplified so that the consumer doesn't get these unpleasant shocks at the time of claim. As products become simpler, yes, you don't need intermediaries. If products are simple, they all get reduced to vanilla ice creams, you can definitely buy online. But more the complexity, more is the need for an advisor or an intermediary in between. Let me take a minute here and give you the stratification of the intermediary market. One, you have insurance companies selling to you directly. Obviously, he's not going to educate you if there's a better product in the market, right? Because he's out to sell his product to you. Sir, mine is best, mine is best, mine is best. So he's going to tell you mine is best. Could be right, could be wrong. Similarly, then you have agents who are representative of that particular insurance company. Again, he is not going to compare with the competitive product which is better than his. He will also give you a limited choice. If he's agent for 3 companies, he say, pick among these 3, sir, they are the best in the world. So his interest is aligned towards the insurance company. Bank assurance, same. They also are not bothered. They have tied up with 3 insurance companies. They will shove it to you. Please buy these 3, nothing else. You don't have a choice. The only channel that gives you choices is the broking channel. We as insurance brokers are not supposed to work for the benefit of insurance companies. We work for the benefit of policyholders. You are my customer. I have to get you the best. If I have to scan 22 companies or 42 companies, I have to scan and give it to you. That is the obligation which the regulator has put on insurance brokers like us, that you are the custodians of the policyholder's interest. You have to see what is best for the consumer and get him the best deal. Which insurance company doesn't matter. So these are the various classes of intermediaries that you have in the marketplace, and we take care of the consumer first, rather than looking at which insurance company gives us more commission. Getting commission is an incidental reason. If I do a good job, you will be my client for a lifetime. If I do a lousy job, you will kick me out and find somebody else next year. So a broker looks after the customer interest, whereas an agent is meant to sell the products which are available in his kitty. So that's the fundamental difference between a broker and an agent. Hope that gives you some clarity.
Perfect. So, sir, actually, that is where I wanted to come, because we have, discussed the intermediary space in quite detail, and we talked about insurance brokers, insurance agents. We also talked about banks, etc. So, I think it's important for us to clarify. I mean, this is what I want you to give a clarification on. What is the fundamental difference? Maybe 4-5 points you can highlight between an insurance broker and an insurance agent. That's one. And secondly, let's say if someone wants to become an insurance broker or an insurance agent, is it okay or is it allowed for an individual to become both, or you have to be an institution, or what kind of parties get these kind of licenses is what I wanted to understand.
Sure.
So these 2 questions, if you can address.
You can't wear 2 hats. You can only wear 1 hat. Either you can be a broker or you can be an agent. You can't be a broker and an agent. But there are a lot of changes which the regulator is now contemplating. They want to allow agents also to represent multiple insurance companies. They have given some degree of freedom now that you can be an agent for 2-3 non-life companies, you can be agent for 3 life companies, and you can be agent for 3 health insurance companies. So they have widened the choice for the broker. But ideally, the channels are separate, the licensing regulations are separate. Brokers predominantly are vetted by the insurance company and appointed as an agent. The regulator doesn't play an active role, whereas to become a broker, you have to get a license from the insurance regulator. There is a capital requirement required. From a direct broker, it's about 50 lakhs of rupees of capital that is required. For a reinsurance broker, it's about 2.5 to 3 crores of rupees that is required. So there is a capital requirement. And then again, there is an evaluation process which the regulator follows before granting a broking license. What is your track record? Do you have qualified people? What kind of business plan that you have built and all that stuff? That is something which you need to convince the regulator. It's not very complicated. So, but yes, there is a due process that has to be followed before you get a license.
Perfect. So what I was able to understand is, to become an insurance broker, you need higher amount of capital, which an agent does not require. Second, the evaluation is done by the insurance company, but the license has to be obtained from the insurance regulator, which is the IRDAI. That is not
Broker only IRDA. Agent is through the insurance company.
okay. So if you want to become an insurance broker, you have to obtain a license from the regulator. That's second. And third, you can deal with multiple insurance companies as a broker, but not as an agent, right?
Agent can also do with limited multiple players. As a broker, you can deal with any company in India.
Okay. And sir,
100%.
regarding the parties who can become insurance brokers, so can an individual become an insurance broker, or is it only limited to institutions?
Become an individual, can become individual, partnership, LLB, private limited, listed company, unlisted company. Anybody can become.
Got it. That's it. Thank you for the fundamental answer.
And from a sector perspective, over the last 5 years, the broking channels or the various distributors, the market, if you were to look at, say, about hypothetically in the year 2019-20, uh, agents had about 24% of the business. It has now come down to 20%. The direct business that the insurance companies used to have was about 30%. It is now down to about 26%. Similarly, the brokers used to have about 25% of the share of the market, which has now become 37% of the market. So
Which period are you referring to?
all other channels are losing market share. The broking channel is increasing the share of the pie of the insurance industry. So broking is becoming the preferred distribution channel in the marketplace over the last 5 years.
So coming to that, so that was my very next question. Before we deep dive into your business model, is what is the estimated size of an insurance broker, industry size for an insurance broker? I understand that 11 lakh crores is the insurance premium that we get as an insurance company, right? That's the size of an insurance
That's the
company.
premium. That's the
premium, right?
So we don't get the premium. We don't get to collect the premium.
Correct.
We get a brokerage of the market, and this
Yeah.
brokerage
So what's that?
vary. So there is some products with 2%, some with 5%, some with 15%, 20%. Life side, the brokerages are more. Non-life side, the brokerages are less. The pure broking industry, we're not talking of agents, we're not talking of direct business. The size of the insurance brokers' revenues, if you were to talk, could be about 25,000 crores, 25 to 30,000 crores. That could be the estimated size of the market.
That's almost 2% of the total industry size.
Yes.
Industry premium. And you said that out of that 11 lakh crores, 37% is represented by insurance brokers, right?
Yes.
So if I were to just think 11 lakh into 37%, that would amount to
but you also understand
4 lakh crores.
Yes. So, but please also understand the brokerage rates can be practically nil. For example, on an individual term like policy, the brokerage is non-existent. That might have a lion's share of the premium. Similarly, there are the government business is also there. Their intermediaries will not be allowed.
Because in this 11 lakh crores, you included new premium or you also included for the renewal premium?
Old also, both. Old and
okay.
Old and new both.
So that's also a fairly decent size, 25,000 crores for the industry, because it's almost 6.5% for that 4 lakh crores, right? So
yes.
they are getting amount of commission. So having said that, now coming to your business model, but before we delve into your business model, of IIRM Holdings Limited, can you walk us through your journey from 1999 till date? How the company has evolved, and also at the same time mention, why did you get into this business? What opportunity that you see back then that made you, get down, into this business?
Yeah. Okay. So we basically started this business in 1999. By background, I'm a chartered accountant and I have worked in various industries in my career, and finally been wanting to do something on my own. So in my earlier employment, I had also worked in the financial services sector in a non-banking finance company. So where we had done stockbroking, corporate lending, retail lending, investment banking, everything that is there in the financial services world. So I was inclined to do something on financial services. And as destiny would have it, that was the period when I was looking at jumping and doing something on my own in 99, 2000, when insurance sector got opened. So then when we were talking to people, hey, this is a sunrise industry. This is a headlight business, not a tail light business. So we said, okay, what can we do? So then people said, worldwide insurance distribution is a big business. Insurance companies don't sell directly. They will always use intermediaries as a broker or agent or etc., etc. And there should be a huge growth opportunity in India. The Indian economy will grow, the insurance sector will grow, the need for professional advisors will be a very good segment. And that kind of fitted in with the background that I had in financial services. It was quite exciting to do something new, something innovative, and the rest is destiny and chance. Things have worked out well, and today we are where we are. So that was what prompted us to get into this. At a pure professional level, let me be very frank, I find it very fascinating today that, as I mentioned, no two claims are separate, no two customers' businesses are same. The nuances of trying to build a risk mitigation solution to a client is very, very satisfying intellectually. You talk to a small shopkeeper, he says, these are my problems, these are my worries, can you have a solution? You have a large $1 billion project, which has its own share of complexities. Then you have people wanting individual health insurances. I want to cover my spouse, I want to cover my children, or I want to cover my relations. Can you give me structured products? Or I want to be in India, I want to be outside India, can you give me a product? Or I want to be placed there but treated elsewhere in the world. So, every day you come up with plethora of challenges, new requirements, new asks are coming in. So it keeps you on your toes. We need knowledge, we need network, we need the ability to fuse all these things to deliver solutions. And now the new ingredient, which is making life very, very exciting for all of us, is technology. And AI is really, is transforming the whole game completely. So these are factors that keep us excited, and we keep on trying to do new things and do more and more of it, and that's the enduring love that I have for this insurance distribution business, and that is what prompted us in, and we still continue to enjoy building this and taking it forward. So that's what I came into this business. If you were to ask the size of the business, I've shown the industry per se grows at 12 to 13%. So if you don't mess up, you should also grow by 12 to 13%. If your insurance was 1 rupee some 10, 12 years back, it would have grown today. If I've done a good job with you, I will automatically grow as the premium grows. The number of customers grows, the business grows. So there has been a good, healthy, organic growth in the insurance business, in the insurance sector, and that definitely makes life easier than when you are fighting against the current of an industry that is shrinking or a business that is static, that is not growing. That becomes far more challenging for that individual business to grow in a non-supportive environment. So we are fortunate that we are in a very, very business that is buoyant, it is going up on its own, and we are also benefiting from that buoyancy. So that is the plus point, or that is the upside and the potential that is still continues to be there in the business. So from a business verticals perspective, broadly, our business is divided into, I would say, 4 segments. First segment is corporate sector. Medium to large corporate customers are my segment of the market. Second segment of the market is called reinsurance, where insurance companies don't carry the entire business on their balance sheet. They want to share the risk with other insurance companies, or inside the country, outside the country, that we call reinsurance. The third segment of the market where we are in is related to retail insurance for individuals. So that's called personal insurance or retail insurance. And the last segment that we are into is wellness and other insurance services like claim processing, etc., which we handle. So these are my 4 verticals that drive our business. And today, yes, my biggest is the corporate business, is the number 1 segment for me. Number 2 is my reinsurance. Number 3 is my wellness and other services. Number 4 is retail. This was the situation till last year. This year, the situation is changing. We are seeing the significant growth of the retail business, when compared to the other three segments. And we see going forward, retail will continue to be far bigger growth segment than whether it is a corporate or a reinsurance or other segments. Because we really want to push the retail segment because the size of the market is humongous on the retail side. Corporate markets are fairly saturated. Most of the large to big companies are already having brokers. They're already using somebody's services. So the potential for organic growth there would be limited. Whereas in retail, it is still a virgin territory. The upsides are huge on the retail side. So we will continue to focus on building the retail. Plus technology is shaping up a lot of innovative stuff on the retail side. So we see a good play of tech versus physical advisory services. So we are looking at a phygital model of expanding our business on the retail side significantly over the next 5 years. In terms of cost structure, the bulk
So,
of
we will get into that in a while. So, I have a few questions before that. So, obviously, IIRM Holdings got listed via backdoor listing rather than, going for the traditional IPO route.
okay.
And we have seen many companies going through that route over, going for a traditional IPO. So, why is there any advantage, why promoters choose to go for the backdoor listing? That is one that has been always in my mind, and I've been curious about it. कि क्यों ऐसा करते हैं लोग, yeah, promoters, and what kind of businesses generally, decided in which situations rather it is better to go for the backdoor listing rather than, going for the IPO.
Okay, let me answer you from my perspective. My answer may not answer the question that you asked. Why others go for it, I frankly can't answer.
Okay.
Our reasoning I can explain to you is that my business has grown steadily over the last 25 years. We haven't raised any capital from the public as such. Whatever capital is either contributed by me or by my friends and my associates.
Okay.
So we haven't picked up any money from the common investors as such. And significant portion of my company's equity is also with my team, who has with me 5 years, 10 years, 15 years, 20 years. So it was always my desire that, look, when you're building an institution, you're building a business, and these people have also helped build this organization, there must be some monetization for them. There should be some exit path for them. They have needs, their families are growing, their family needs will be there. So, and regular salary bonus is one part, but you need wealth creation. If you need wealth creation to your team, the best option is that if you are listed, it is traded, then you can see the direct correlation of your business growth and the wealth appreciation in the marketplace. That wealth appreciation is always far more than the monthly or the annual compensations which the business can pay. So that was one of my fundamental drivers. Second, in today's market, if you're planning an IPO, there is a minimum critical size that an IPO has to be. You can't do a 50 crore IPO. You used to get away with that 20 years ago. But now you can't do a 25 crore or a 50 crore IPO. The number is much significant capital you raise. The fundamental question is, I can raise for a big amount of capital. Let's say I raise 500 crores. Where am I going to deploy that 500 crores? How am I going to sustain returns on that 500 crores? Unless you have a tangible business plan to require that kind of capital intensive business, IPO doesn't make sense. Yes, there are certain companies who are coming on the fintech side who have adopted the model that, look, we need a lot of capital for us to reach out into the BTC market. It takes time. It takes a lot of 5, 6, 7 years of sustained capital burn, technology investment, building a distribution platform, reaching out to consumers, advertising, promotion, blah, blah, blah. That needs a huge capital. That is why the fintechs had a business model to raise capital, deploy capital, and build their brands. Whereas I am not into a fintech business. We're into the traditional brick and mortar business. We are very strong believers in trying to be consultants, professional advisory, that one-to-one touch with the client is what we have been harping as a business philosophy. So I didn't see the great need for a huge amount of capital. So that is why this reverse backdoor listing or whatever you want to call made sense to me. That I acquired a listed company from the Bombay Stock Exchange. I did an open offer, got control of the company. Then this holding company acquired all my operating businesses. So we have a holdco and wholly owned subsidiaries are the ones which do the business. So that was my driver for going through this route. I honestly don't know what motives others have. If you tell me, is it easier, faster, quicker? No, this has its own challenges. It's equally time consuming and it is equally rigorous and vigorous. You have to get SEBI approval, you have to get Bombay Stock Exchange approval. So the vetting process and the complexities are identical to an IPO. So that was what was my driver, and that was the rationale behind what we did in this.
Now that my curiosity is out of the window, now coming back to your business. So since you mentioned you have four business verticals: corporate, reinsurance, wellness, and retail, right? So now coming to the corporate insurance bit. So can you just highlight what is it the product that you deliver in the corporate insurance business, and what kind of profitability that you see, or what kind of rather commission rates that you see in that kind of business uh, for our viewers?
Okay. The corporate business that we do would broadly, I would say, have two major components of what a corporate buys. One, a corporate buys group health insurance, group accident insurance, and group life insurance. That's for the benefit of their employees. That's where the bulk of the money is spent. The other part of the insurance spending, which a corporate does, is on the property. They own factories, they own machine, land, equipment, they do construction, they do expansion of their projects, etc. Then they have goods which are getting shipped, etc. They will have marine insurance, etc. These are the variety of, depending on the industry, these are the risks that the corporate has. So you have the health employee related and non-employee related is what I would broadly bucket them as to. The employee related segment is almost the bigger player in most companies, unless it's a very large manufacturing company. Otherwise, the employee insurance takes a fair amount of chunk in all non-manufacturing companies. It will be as high as 70-80%. Manufacturing, health may be about 30%, property, etc. would be higher number. The commission structure that we get will vary from client to client. There is no stipulated uniform rate or a single rate which is prescribed in the market. It could range from 0.5% commission or to zero commission, where the customer says, don't take any commission, I'll give you fees for this account, earning 15% also on a policy. So it depends on consumers, it depends on the product, it depends on the market. But as a thumb rule, if you were to ask me, health insurance, the average thumb rule is 5 to 7.5% is the thumb rule on health related. Non-health related, it could be 7% to 12.5% is the thumb rule from a brokerage perspective. This is on the corporate side. If you were to talk about the reinsurance side,
So before we get to the reinsurance, so on the corporate, my understanding is the corporates are a bit savvy, right? They have an entire team of HR and accounts and everything, who understand probably some of the nuances of the insurance industry. Why don't they directly opt to directly deal with the insurance company rather than intermediary? So what drives them to have an intermediary?
Definitely, some of them do go direct. It's not that they are all going through intermediaries.
Okay.
My answer is, as I mentioned to you, yes, you are a corporate buyer. You have been buying insurance for 10 years or 15 years. You have a lot of expertise. You have a broad understanding of your needs. And you can call 5, 7, 8, 10 insurance companies and look at the best. But you do that once a year, right? You'll be doing that once a year. Whereas we do it every day for a living. Knowledge that we will bring to the table. Knowledge is just not the price. Knowledge is just not the product that you're buying from them. I can tell you, look, your competition is buying something else. There is some innovation which the competition has done. Somebody else in your industry or some other industry has done something else. This cross pollination of knowledge, information, and practices and track record of these insurance companies.
Okay.
This information supply that we give to the client is the real differentiator. And when there is a complexity, when there is a claim, that is again where our knowledge pool will come in, where we will be able to say, how do you get this claim out from the insurance company? They are not vanilla. The moment the claim comes, the outlook of the insurance company is to interpret your policy strictly and say, does this fall? Does it fall? Doesn't fall? Not fall. He is not going to say, this poor man has paid premium for 15 years. We should, pay this claim to him. That's not their outlook. They are also accountable to their internal governance mechanism. Does the document cover or not? So the question comes, how do you present your argument? How do you present your documents to the insurer, to the loss assessor? How do you identify the root cause of the loss and convince the insurance company, hey, this falls within the parameters of the policy? So you really need a competent insurance broker for getting your claims paid 100% or 90% or 80%, whatever is payable. That efficiency and that is the service you are buying. If you don't have a claim that doesn't get tested, God forbid, 2, 3, 5, 7, 8 years, you may not get it. But it's a small price to pay for getting an expert on your side. Second, whether you use an intermediary or not, the price is going to be the same for you. The insurance company doesn't give you a 5% discount if you don't go through an intermediary.
Correct.
You negotiate the price to the bare minimum that you want to negotiate. The intermediary is paid by the insurer because we take care of the headache for the insurer. We take care of the headache for the client both. Since we are facilitating work for both, interpreting each other's point of views in the language that they understand, use an intermediary. That's the value add we bring to the table.
Fair point. That's a fair argument. So now, okay, coming to the reinsurance business. So how does our modus operandi in the reinsurance business work?
The reinsurance modus operandi is very simple. Insurance companies pick up the premium from the customers. They put their balance sheet at risk.
Right.
Ideally, they would not want to keep 100%. They may keep 20, 30, 40, 50% on their balance sheet. Balance they want to offload and insure with somebody else. Inside the country, outside the country. There again, you'll ask the question, they know all the insurance companies, they can send out emails, etc. But they again will have finite ability, finite reach, whereas our reach is infinite. We know the pulses of the market. You may have a risk, for example, which no insurance company in India will touch. Whereas I know somebody in London is willing to do it, or somebody in Australia is doing it, or somebody in the Chinese market, or the Russian market, or the US market has the appetite for it. We are able to send it across there, get the terms, and give it to you. So we help in distributing the risk over a much, much wider markets, which an insurer on their own will not do. But if there are standard risks and they can go to the national reinsurer GIC, they do go directly to GIC. But again, in the reinsurance market, nobody picks up the whole risk and say, give it to me. Each reinsurer typically will say, I'll take 3% of the risk, I'll take 5% of the risk. So that means you will have to search for 5, 7, 8, 10, 12 players to place these small shares. And tomorrow when there is a claim, again you will have to justify to all so many players. You have to collect money, you have to do paperwork, and this doesn't get over in 1 year. The stretch is there for 5 years, 7 years, 8 years. It takes before the file gets closed. So it becomes very complicated for an insurer. Dump it on a broker, which is on a variable cost basis. There is no fixed cost of salaries and having staff in your branch or in your department or in your head office. Rely on the intermediary who is doing this job day in and day out. for all insurance companies. So we have the size, we have the scale, we have the expertise to do this work, and that's why insurers use reinsurance brokers.
So what kind of payout do we get generally? Let's say you reinsure 100 crores worth of premium, then how much kind of
It's again not a very simple linear equation. Again, complexities are there, product-wise complexities. It's a commercial negotiation. It
then
can
also just a broad commercial
it can
range,
range from 2.5% to 22.5%.
22.5%.
Yes.
Why would anyone pay 22.5%? I'm now clear because when at the inception of the policy, probably the insurance company must have paid the intermediary 5 odd percent or 10 odd percent.
So what
Right.
happens is out of this 22.5% commission, the broker keeps something, the insurance company also keeps the commission.
Insurance company keeps the commission.
Yes, because he is surrendering the premium. Suppose he has kept 50% with himself and he has surrendered 50%. On 15%, on the 50% he has surrendered. If you have got 22.5%, let's say broker ideally will keep 7.5%. 15% commission goes to the insurance company. Insurance company will keep 5% or 10%, and 5% he gives to the direct broker.
So, if I think about it, if I have 100 crore rupees of insurance that I'm willing to get reinsurance, take it off my balance sheet. And if I'm going to pay 22.5 crores for that, might as well, I accept the loss ratio of 22 or 30 odd crores. Doesn't that make sense? I'm
Very
just
nice. Very nice. But you have a capital of 200 crores and you have insured a 5,000 crore asset. Then what do you do?
That is.
So the sum insured is your loss, not the premium. I have insured
Correct.
5,000 crore factory. I may have given you a 5 crore premium.
Correct.
Sir, you are carrying a 5,000 crore risk. It is balance sheet out. So it
True.
doesn't. That's the reason why they will go for reinsurance.
Fair point. So, okay, that's a very good understanding of the insurance market, and most importantly, the very important role that intermediary like you play in that reinsurance market. Now, coming to the wellness insurance, what is it that we do in wellness insurance? How does everything
We
work?
do two aspects of wellness. One, we take care of the annual health for the corporate insurance. We give this as a value-added service that we'll facilitate annual health checkups. We'll organize some special medical clinics, medical clients, etc. Various kinds of other wellness programs in consultation with corporate HR, etc. We do that. Plus, there are a lot of corporates which are doing self-reimbursement of the medical expenses to their employees. We help in processing such claims, etc. So where we process the claims and the company pays for it, there is no insurance involved in that. And that is why we do that also as part of the wellness activity, etc. So that is what we do on the wellness piece.
So basically help companies for the medical health checkup of their employees and everything.
So I am not providing any wellness services from my side. I am not having any such wellness services to provide. I'm a facilitator for these kind of services. We tie up with various diagnostic clinics, etc., pharmacy tie-ups, etc. We do for getting you discounted medicine, etc. You pay the pharmacy, you get your medication.
So how does you generate?
I don't play any role there.
How do you generate revenue from that?
The corporates pay us some amount of money. Sometimes insurance companies pay us money for that. And sometimes we give it as a free service. Because we are making brokerage on the other side, we said, okay, this is a value-added service.
Okay. So now coming to the fourth segment, that is retail insurance. Now, retail insurance is more of a wider offering, and for that, you need to have a good distribution network to reach that retail, public. So how are you cracking that model? How are you trying to penetrate that? Because people need to have that brand recall that there is some IIRM holding or whatever brand you guys are using, to able to log into your website or download your app and transact. So I think it's altogether different ball game compared to what we have been traditionally doing. It's more of a B2B kind of a business, right?
Absolutely right.
So it's altogether different ball game. So how are you, positioned? What are you doing? Just over to you.
See, broadly speaking, on the retail side, what our focus is not going to be B2C. Our focus is only going to be B2B2C. So our entire strategy for the last 2 years on the retail has been to get a foothold into the market, as you rightly said. We want to be a credible player on the retail side. So we have tied up with a lot of insurance distributors, as they're called in our insurance jargon, POSPs, point of sale persons. So we built a large network of POSPs in about 5, 7 states across the country. And we are trying to build a long-term sustainable relationship with my point of sale persons. We are trying to tell them that we are their long-term partners and we have no aspirations to bypass them and go to their customer ever, because I am not encouraging B2C at all. So that is kind of giving them comfort. There are a lot of other players in the market who do B2C. They're also canvassing through the agents. So they are using multiple channels to grow their businesses. At times there could be conflict of interest, etc. So whereas in my case, there's going to be no conflict of interest at all ever. So we have made that very clear, and that has given comfort to a lot of agents or POSPs to deal with us. And that has what helped me gain traction in the last 2 years on the POSP space.
So on the PSP, yeah, sorry, please continue.
Yeah. Plus, what we want to do going forward is, as I mentioned, we do large volume of group health insurance. We have large organizations, 5,000 employees, 10,000 employees, 100,000 employees. Today, we've never catered to their individual requirements. We have always catered only to what is being paid by the company. Boss, you want an individual insurance? Sorry, we are not there. Please go somewhere else. Or I'll refer somebody and say thank you. I just helped, but I didn't take it as a business. But now with technology plumbing in, a lot of tech platforms being coming in, we thought when they are in touch with me every day, I serve their group needs. Why not serve their individual needs? That will be my future aspirations for the next 2, 3 years, to tap into that segment to do the retail business. So that will again be B2B2C. There also, I will not ask him to go to my website and buy the insurance. Please, you need insurance? My guy is there in your office or in my office. Please reach out. We will talk. We will have an exchange and then we'll facilitate a transaction for you. So we want interactions to happen with my consumer before I place a deal. So this is my strategy for the corporate. That is my strategy for the retail market. So it's a fusion of these two. That's my retail game plan.
Sure. So when it comes to POSP network, so I think there's a limitation on, you cannot deal with all the complex products when you are POSP network, right? So can you just help us with what are the bouquets of offering that you're offering in a POSP?
The typical product is motor insurance, health insurance, and life insurance.
I think the majority would be motor, or is it?
Majority is motor.
So how does the commission work? So let's say in motor insurance, you get 5% commission from the insurance company. How much do you share with the POSP?
It is much higher. It is much higher. It's not 5%. It's almost 25, 30%.
25, 30%.
Yeah.
Okay. So out of, let's say, for 100 crores of insurance premium that your POSP network sold, you are getting, let's say, 25 crores of revenue from the insurance company. How much do you share it with your PSP network and how much do you retain it with yourself?
It's again, as I said, a structured understanding with variety of players. One, there is a bare minimum compensation that we get irrespective of business volume to build my network. Then there is a variable scheme based on the targets, etc., that we work out with each of these distributors. The smaller players is much lower. The bigger distributor or the bigger the volume, he gets the lion's share of the business. So it's a very flexible, structured understanding that we build with these players. There's no one number or a specific number which you can generalize and say this is what we are going to pay.
Then also just a broad understanding. Let's say I today on board as a POSP, agent onto your platform. So what is the fixed pay that you will give and what kind of targets will
I'm not giving you a target. You have to convince me what you will do for me. I'm going to negotiate with you.
Let's say I just come and say
I need a minimum criteria. No, you may be in a small town. So then your aspirations will be smaller. You are in a big player. So it's completely flexible. So there is no indication that we would want to put on a table, say, I'm only going to give you 5,000. I may give one fellow 1,000 rupees, another fellow may give 50,000 fixed also.
No, I understand that part. So let's see when I come by and say I will commit to a crore of insurance premium, for example, on the year one. So now probably what kind of revenue share I get? Uh, just hypothetically speaking.
Depends on the product mix that you have.
Motor insurance, 100% motor insurance.
Again, motor insurance, again, I'm saying the motor has a lot of segmentation. Is it commercial vehicle? Is it passenger vehicle? Yes, the brokerages are not uniform. You will be surprised that on motor insurance, there are almost 200 plus variations on the commissions that we get from insurance companies. And again, there are certain vehicles which they say, if you are in this particular district, not insured. Thank you, I'm not going to give you insurance. Or sometimes there's no brokerage on this. So it's a very complex field that has to be talked about. So I can't give you a thumb rule and say, hey man, 50, 20, 70, 20, 80, 40. That's not possible.
Okay. So what's the network that you have created on the PSP side? How many agents have you onboarded so far?
I think we have about 2,000 people today on board.
2,000 people. Okay. Navid, do you have any question?
Yes, sir. So, sir, I again want to get into the fundamentals of the business. So, we are an insurance broker, right? And as you explained initially, while explaining the difference between insurance broker and an insurance agent, you said insurance broker can deal with multiple insurance companies or as many insurance companies.
Yeah.
Now, with that, flexibility or with that kind of luxury, also I believe comes a very important fiduciary responsibility that you have to up your game as far as the due diligence of these insurance companies are concerned. Because now that you are able to work with multiple insurance companies, as many as you want, your due diligence game has to be top notch. Because end of the day, your business will grow if you are able to deliver the right product to the right customer. So now what I want you to tell us is that IIRM Holdings, how have you structured this due diligence process so that you are able to A, work with the right kind of insurance company, and B, in the set of insurance companies that you're working with, you are able to pick the right product by the right manufacturer and offer it to your clients.
So, see, from a due diligence perspective, what you mentioned is I frankly don't have to do due diligence on their credibility as such. What we do is the product comparison that we do. So, for example, if you are running a business establishment, I come to you, I pitch you my capabilities, my credentials, and say, sir, this is my business. This is what we have done in the last 25 years. Typically, you are doing this kind of a business. We understand this should be your risks. And this ABCD should be the insurance policies you have taken. And if we have some case studies or anecdotal studies, we share that with you saying, say, sir, that business similar to you had this problem, which the insurance could not get covered, or they had a problem in getting that sorted out. Do you have such problems? So once we understand your nature of business, then we say, can you share us your insurance current policy copies? So we'll sign a non-disclosure agreement, pick up those insurance policies. We'll put our insurance expert to study the entire policy and give you a risk review report. So this is the review report. Everything is picture perfect. We'll say, thank you, sir. You got a great policy. Everything done. I don't see me adding any. Maybe I can get you a better price if you want to shop around. That also depends on the type of policy and these market situations. If we find gaps, then the customer is impressed. Okay, you found this gap. Can we get it covered? Can we rectify the policy? Then we prepare a request for quotation, get it approved by you, and we float it to about 10, 12 insurance companies. Then we chase those 10, 12 insurance companies to give quotations. Then we review each quotation through a microscope to make sure they are all comparable to each other and shortlist 3 or 4 out of that, present it to the client and say, these are the 3, 4 shortlisted insurers who meet all the criteria that you're talking about. These are the pricings that they have indicated. Would you like to meet them? Have a conversation with all of them. If the client says yes, then we facilitate that interaction with all of them. Then the customer takes a call. I want to go with this guy with this price, or I want to go with this price, but this price is not okay. That fellow's price is the best. So we'll try to go back to the insurance. Hey, you have to match that price with your coverages. Client is happy. Then you please go with him. Then we get the transaction completed for him, and we are responsible for the next 12 months to make sure that the policy is running smooth, timely informations are shared, any losses happen, we inform the insurance company, get the documentation done, submit it, get the insurer to pay the money to the customer. This is my entire journey that I do with the corporate. So that is why we have high quality teams, qualified manpower, experience in the insurance industry. We have built technology platforms inside the company to store this information so that information retrieval can happen. We are building AI tools to do benchmarking of various customers, etc. We are building tools to give ready-made analytics to the client. He can look at his 3-year, 5-year, 8-year track record. When are his policies falling due for renewal? What is the status of their various claims, etc. These are all the tech initiatives that we are bringing on board, which we give to the client. This is the holistic management tool for insurance. The A to Z management of insurance tools is what we give to the corporate customers.
Understood. So, sir, just from, I'm curious to know, do you also have diversification mechanisms in place that, hey, this is the amount of business I want to give to this company and not beyond that, or something of that sort?
No, no, no. We
Okay.
don't have a policy or a guideline like that. But yes, if we are sensing market feedback that there is some disconnect in certain insurance companies, their approach to claim payments is not very customer friendly, we share that feedback with the customers in confidence. But I don't have concrete data to say, hey, this guy is bad or this guy is good. So I'm doing an insurer rating as such. But the regulator themselves is publishing data today. How many people are processing how many claims? What is their frequency? What is the rate of rejection, etc. So that data we educate the clients. Hey, this is the regulatory information on claim processing capabilities of various companies. So we just share with them our experiences that we have had, but we do not have a preset limit. Say I can give 7% of my business to this guy, 28% to this guy. That's not. And why also I tell you, because I may have a client who's very good, very valuable to me. But you as an insurance man, I don't want to carry this risk. I like you. You're my best friend, but unfortunately, I can't drive that business to you. So it is left, we don't influence the customer's choice of insurance. We recommend, but I'm not going to tell him, hey, you have to go with this man. No. My fundamental duty as an insurance broker is to provide choice to client. Otherwise, you go with an agent. No, why are you going with a broker? The purpose of a broker is to create a choice for you. And when I'm giving you a choice, you are the guy making the call. The consumer makes the call. I, as a broker, don't want to influence that. I need to provide all information, all tools, answer all your questions so that you get the best possible deal in the market at that point of time.
Sorry. Yeah. So now coming to your, you understood the revenue model. Now coming to your cost structure. So essentially, just to deliver the kind of generate the kind of revenue that we generate, what are the major costs as a business that we incur, and how are those costs expected to shape up? Yeah, how are those shaping up right now?
Typically, it's employee cost, which constitutes almost 50-55% of our cost is employee cost, and the 15-20% is office infrastructure. That's these are two simple elements of cost: people,
Right.
infrastructure.
That's also part of tech cost, or you have made it part of infrastructure.
Tech is part of infrastructure.
Okay. So on the employee front, how does your employee breakup looks like in the terms of how many you have relationship managers, how many are compliance or product managers or admin or yeah.
We have a very simple flat structure. We don't have a very complicated layer structure. We just have customer relationship managers and a small support team to support them in acquiring customers and as well as servicing customers. So we do not have a separate team to bring in customers and the set of people to service. Our model is very unified model. Whoever brings the customer is answerable to the customer for service. He needs assistance, he has staff to assist him. But the relationship with the client is unified with one guy. So he has to retain his customers and bring in new customers as we progress in our journey. So we have, for each verticalized, there's a separate team. Retail team is separate, corporate team is separate, wellness team is separate, reinsurance team is separate. So their respective verticals, there are fairly watertight compartments between them, so there is no great fungibility, etc. Of course, people can get transferred from one to the other, but from a functionality perspective, they are all independent, and all branches are also independent. They make their own independent calls. The customer is local, the insurer is local, the servicing is local, the teams are local across the country. So that's a fairly decentralized, flat structure that we have in terms of people, etc.
What is the employee strength that you have right now?
We currently have about 400 odd people across the country in various verticals.
So, just to understand the unit economics, since, major cost is, relationship managers. So typically, let's say, you hire a new relationship manager, right, with no industry experience, right? So how much time does it take for the relationship manager to break even for you in terms of, doing sales and everything?
Okay. First question, I will not want to hire somebody who's not from the industry.
No, not from the industry, probably a
You
fresher
have to
or
have
PR or
insurance experience. If you are not having insurance experience, it's going to be a very long challenge.
Okay, so let's say someone
If
who
you
has a couple
want
of
to
years of
be an
industry
insurance
experience.
guy, you have to have insurance experience. Either you have done an insurance degree, or you have worked for an insurance company, or you have worked for an insurance intermediary. Yes, that is what we hire. So, and the hiring takes place at various levels. We have freshers with 1-2 years experience, 5 years experience, 10-year experience, 25-year experience. So you have a wide variety of team that you have. And let me also clarify, on the corporate business or on the reinsurance side, you cannot do unit economics because a deal cannot be won by one guy. So, for example, I have a project now, a big road project of 7,000 crores that is getting built in some part of the country. So one man can't go in and do that insurance. Hey man, this is my business. I have done it. No, he would need support from the technical team. He would need somebody from the marketing team. He might need the help of my managing director, or even if I am required, then I go and pull in and pitch in into the account. And yes, ultimately we'll say he's the account manager for the account. But there's a whole bunch of 5, 7, 8 guys who go, support, get the transaction done. So if you were to just divide the unit economics, it doesn't give you the right picture. It's an arithmetical division, but the business doesn't function like that. Because what happens in that typical analysis, 400 divided by revenue. So increase this 400 to 800, you will double the revenue. No, it doesn't work like that. Similarly, one guy may have 22 clients, but his revenue may be small. But there may be one guy who's equivalent to 22 clients if he has got a very large client. So this is like a consulting business. This is like a consulting business or a legal professional business. You win a big case, you have got a big case, you have a big retainer. You have a small case, you have a small retainer. The complexity, the time spending might vary, but I can't price it like that. And as I said, it's a competitive environment. I may spend 4 months in getting a transaction. I may just make a 2% brokerage. There may be another deal which came and fell in my lap, which I closed in 4 hours flat, and I make 10% on that. So there is I don't want to put a straight jacket number. I've been asked by quite a few analysts, this number I give me this person, but I don't get into that trick. That's for a retail business you have. Retail, you have unit economics. This is a consulting business. In consulting business, unit economics don't work. Unit economics when you're doing mass scale. I have 10 salesmen per day, 100 calls. 100 calls will convert into 5 conversions. 5 conversions, average ticket size is this. This is the average premium. This is the average brokerage. That works for retail. It doesn't work for corporate. They were
Okay, so
doing
what about,
ad agency. Can you go to an ad agency and ask him to give you the cost of creativity per person? No, it doesn't work. He gets a Coke account, he gets a 10 crore account. He gets a
Mhm.
smaller account, he gets 5 lakhs. So it's a consulting business. It's an advisory business. If not, number of people divided unit economics doesn't work. Retail, it works. Corporate doesn't work.
Hmm. That's a fair insight, rather, because we never thought it at least
So
this way.
that's the reality that I'm describing to you. That's the reality that I have.
So, having with this, so I want to ask one more question on. So there are many, we as an investors, outsiders, tend to look at businesses from a certain angle, right? We look at the financials, we might look at your premium numbers, number of customers, and all those metrics, right? But there is certain metric that you as a business owner might be looking at, which we as a outsiders and analyst might not be tracking, right? And that number or that metric is equally important that we don't see. Is there any metric that we should look at a business owner that you look at, but we don't?
And that's a good question. Let me just. The only, I would not call it a metrics. When I do evaluation of my team's performances, etc., we tend to give importance also to the kind of effort the guy has put in.
Hmm.
Because I can't just blame an individual. Yes, you do have a target. Boss, you have to do X revenue, etc. The guy has really gone out, reached out, or he has an existing book of business. You lose some of that business for circumstances beyond your control. For example, I had a client. If the client has got acquired by somebody else and got merged,
Hmm.
they lose the business. So do I blame that individual and say, man, you did a lousy job? No, he done a fantastic service. The client is giving you an appreciation letter, but he's been sold. Or the key decision maker with whom we were dealing for 5 years. He has moved to a new company. There's a new gentleman who's come. He has his own comfort zone. He says, man, why not try somebody else? Or there are a couple of corporates who say we have a policy that we need to change the vendor every 5 years. Same service provider beyond 5 years, we don't want to control. So if my bad luck, I inherited it only for 2 years. After 2 years, I lose it. So when I look at my KPIs, the broad parameters that you look at are definitely what is relevant to us. At the end of the day, it is EBITDA that matters for any commercial organization. If there is EBITDA only, you will survive. If there is positive EBITDA growth, you will grow as an organization. So
Hmm.
it's not that we overlook the EBITDA aspect. We definitely look at the EBITDA as a very critical parameter of what they are generating. So how much
Okay.
is the cost I'm spending per unit business? How much are they giving me as a return on that? But are there any rigid benchmarks? No. General expectation in industry is at least you must be able to generate twice the employee cost. That's the typical industry in the broking industry worldwide. 2.5x, 3x of the M cost is what you should be generating as a revenue.
Hmm. Fair point. Okay. Thank you. Okay, that's a fair understanding. So now, coming to the international part, so I think you recently entered few of the markets like Sri Lanka, Kenya, Singapore, Maldives. So my first question is, considering the size that of the industry, Indian industry that we discussed at the start of our podcast, why did you actually foray into the international market? That's one. Then I'll probably ask the other question.
Just give me a moment.
Sure.
Yeah. See, why have we got into the international market? My motives again were, as I mentioned, we were into reinsurance. We were doing it in India. We came across opportunities from Sri Lanka, Maldives, Africa. A lot of reinsurance inquiries came. We went to various conferences, met lots of people from those markets, and we started growing a reinsurance book of business in all these three places. Once we got familiar with the reinsurance market for about 3 to 5 years, then I felt there was a opportunity of replicating the India story there from a technology standpoint of view, from a product complexity point of view, service delivery, the depth and potential of the broking industry there was far below what we do in India. Because in Indian market, its size has helped it, complexities are more, and we are in a very competitive world out here. So what we learned in 20 years, I thought can be replicated there in 4, 5, 7 years. And those markets are really developing also very fast. They're developing faster than us, not from a size perspective, but from a change perspective, they are there. So these learnings in India, we thought can be plugged in into those markets. They are fairly small. The investment required was small. So, but it was good to go and work in environments which we are not familiar with. Born in India, educated in India, worked only in India. So it was a good challenge that motivated me. Can we do something beyond our own borders? So we've been in Sri Lanka and Maldives for about 5 years. We were at the bottom of the pegging table. We are among the top 5, top 10 brokers out there in those two markets. And Africa, we just recently ventured last year because Africa, we've been wanting to do for 3 years, but we're not getting the right team and combination. So now we finally got the team, the combination right. So we have started Africa because we see Africa as a huge potential for the future. This is going to Africa as a continent, as good a future as India in the future. They're extremely moving fast on the development curve. Infrastructures are changing rapidly. Technology applications are going in there. Manpower is very young there from a demographic profile. Like India got the advantage of demographic profile 5, 7 years ago and will continue for 10 years ago. Africa is the next continent which will have the advantages of demography. So we want to stay embedded with the African story at the early stages and ride the curve upwards like we are riding it in India. So these are my drivers that made me go into these countries. And the Indian diaspora, whether it is Sri Lanka, whether it is Maldives or East Africa, there's a lot of Indian companies out there, a lot of Indians who run the businesses out there. The insurance company professionals are from India. So there was a lot of good fit that we found in adding to what we are already doing, and it kind of de-risks my business. So that was my
How much does the international business contribute to your revenue today?
hardly 5-7%.
So at a 5-7% on a top line, you have essentially become top 5-10 brokers in that industry.
Yeah, they were very small markets.
Okay.
Very small markets.
So generally, so whenever you try to penetrate into this markets, do you get into some JV with some local players or any local adaptations that you have to do?
See, Sri Lanka is 100% owned by us. Maldives, there's a requirement of 70/26. Africa, it is 60/40.
Okay. So you do have to take some local adaptations.
Yes, please.
Okay. So, and are you profitable on these markets?
Oh, yes, absolutely.
Okay. So, right now, technology has made a prominent role, right, even in your industry and everyone's industry. So how, technology is shaping up the way you deliver your service, your customers, or your overall, customer experience or your customer acquisition, or just your business processes. How is it shaping up now?
Tech definitely is going to be a huge game changer. It has made rapid strides over the last 3-4 years. The insurance companies are adopting technology. The insurance brokers are adopting technology, and the fintechs have helped accelerate this whole momentum across the sector. So tech will transform quite a few aspects of typical broking. One, today, insurance, as I kept on harping to you over the last 1.5 hours, is knowledge, 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 knowledge. Knowledge was becoming a proprietary thing stored in each individual's brain. So from a individual's knowledge levels, the tech platforms that are now we are seeing and the ability of tech to become more intelligent is going to create a journey of institutional memory. It is not an individual's expertise, but it is an institutional expertise that is going to happen. So I worked in insurance industry for 25 years. I'm a very knowledgeable guy. This fellow is a bacha. He's joined 2 years ago. What does he know? That could be the refrain. But trust me, 2 years from today, I can't make the dialogue. I've been doing 30 years. The young guy will say, hello, 30 years is the learning. Now tell me what. So that is what tech will disrupt. Not only insurance, any other space. Knowledge used to be proprietary. Knowledge used to be individual driven, experience driven. So now anybody can benefit from my experience. What my experience? Sitting in one corner of the globe, you can get benefit of 20 countries, 50 countries, what kind of claims have happened, what kind of policies are there in the world. Within maybe 5 minutes, your AI guy is going to compare and plunk it to you. And if you plug in, this is the solution it's going to give you. So that will answer your question. If I were to hire a novice, a fresh guy who's just done his engineering or MBA or BA in arts, he can learn insurance in 15 days time. The knowledge curve is going to get crushed. So knowledge as a tool which was proprietary will become institutional tool. Now the challenge for the broking industry is, can you create mechanisms inside your company that you extract these individual learning into an institutional learning? You have gone and met a client. I have gone and met a client. What discussed, what transpired with that client today doesn't get translated into the system. It is there in my brain, it is there in my diary. But if I were to put it into my system, tomorrow, even if I am not going to the client, somebody else is going, he can open up and say, oh, this was what was discussed last time. Then he can pick up the threads from there and do a seamless support service delivery to the client. So that's what technology will do. It will disrupt the service delivery. It will disrupt the knowledge mechanism. It will, I'm telling you, sooner or later, you will run out of emails. We won't need emails. Today, email is what keeps all the information flowing. With your API integrations happening, the need for email exchanges will disappear. You will be connected to the insurer. You will have your tech platform connected to the client system. Data will move in here, data will move in there. The role of the broker is to move to the next level, where you do high-level analytics, you do benchmarking, you do some trend analysis. You really have to think out of the box to add value. That's what tech will force the companies to do. But that needs a lot of investments, a lot of patience, blah, blah, blah.
So, sir, I have a question where you might need to jog your memory a little bit. So this is again on the tech side. So, I mean, if I divide the business for you in three parts, one is the customer onboarding, second is the retention of customers, and third is the servicing of customers, where you
Yep.
go and get them the right claims which they truly deserve. So, can you just give us a comparison? Key, erstwhile technology was operating this way, be it onboarding, retaining, or servicing. But now with this new technology coming in, things have changed. So can you give one example in each of these three sections where the technology has made a difference?
What do you mean by three sections?
So onboarding, retaining, as well as servicing.
I don't know, I can split it that way, but I can give you 1, 2, 3, 4 simple examples.
Sure.
Let me say hypothetically, your company, if it had say 500 employees, I came to you 20 years ago, you wanted a group health program. I would have sat with you, you would have, how many employees? 500. Okay, noted, sir. After 4 days, I'll come back to you. Sir, can I know the age of your 500 employees? How many are 0 to 25? How many are 25 to 30, 30 to 50? Then I take that data. Then again, I'll come back, sir, you want to cover his employee, spouse, children. Can I get the data of spouse and children? So 20 years ago, I used to get an Excel file after 1 month. And then I used to get you the quote. I used to do manual computation. Then I'll send you a quote. You took the policy. Brilliant. 2 months later, some 10 people resign. 5 new people join. So that's a process which happens every month. Incoming, outgoing, total mess. You forgot to email me, or you mailed me, my guy forgot to send to insurer. There is a claim, that fellow is not covered under the policy. Somebody else who has already resigned is gone. He's already taking benefits after resigning. So you have this whole mess. Now everything of this kind is completely online. So we give you a portal. You please enroll the employee. The day the employee becomes your employee, code is generated, email is generated, a welcome email goes, hey man, your company is providing insurance for you, provided you log in, username, password, give all these details. So the moment an employee resigns, there is an alert, your system triggers that this guy has resigned, stop his benefits. So this is a very, very simple example of where things have dramatically changed from the administration perspective. Second part, you have 100,000 employees, just imagine. How on earth am I going to communicate to people? How am I going to tell them what is covered, what is not covered? Good old days, we used to conduct physical meetings in the customers' offices for about almost 3-4 weeks, town halls, addressing them, showing them charts, this is what is covered, blah, 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 blah. Now, please log into the portal, man. These are all your benefits that are available. These are the exclusions. These are your frequently answered questions. I'm providing you a chat bot. Talk to the chat bot. Or there is a call center. Reach out to the call center. Get your answers done. The next level now, people are saying, okay, why are we still interacting with HR departments? Why don't I do an API integration with your payroll package? You add a guy, it comes to my software, it will compute the premium, it will debit it to your deposit account, send the remittance to the insurance company sends it back to you. It's all seamlessly covered. I don't need an email every week from your software. You're downloading additions, deleting, and sending an Excel file still. Please don't send me Excel files. I'm giving you online integration. Similarly, manufacturing companies have material going out every day, material going in, coming, transportation, marine side. That used to be a nightmare. You have to send a fax, email to insurance company, consignment number, invoice number, blah, 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 blah. Please send me an insurance certificate. Somebody runs to the insurance company, gets it, send it back to you. Now the online tools have been given to client. Don't call the broker, don't call the insurer. Please log in your lorry number, LR number, invoice number, punch it, here is your insurance certificate, go. The next level, at an individual level, you want a car insurance, you want a term life insurance, you want a travel insurance. Don't even call the broker. Even at night, 2 o'clock, you're catching a 5 o'clock flight in the morning, log in, take your travel insurance in 2 minutes and go home. So this is what technology has already transformed the delivery of the product, of the service, and retention. Earlier, if you ask me, can you give me last 5 years history, sir, I'll say, plus give me 2 weeks. I have to figure out which file, where I have to do the bloody analysis. Now it is available at a click of a button. 5-year data, please see 5-year, 10-year data. Whichever way you want to analyze is available. So this is what technology has transformed how insurance service deliveries are happening. Now they're talking of digital signatures, like you have DMAT for shares. Now insurance policy DMAT has already taken place. Now the regulator is pushing, put every policy, no physical policy. There is a repository created. Seamless, you will get reminders. Oh, I forgot to renew, broker forgot to tell me, or he called me, I did not respond. Ready-made information for you. So this is what technology has done and will continue to do much more.
Okay. So, so that's a fairly detailed answer on the technology bit with very good examples. So now coming to any industry, with considering the size and the opportunity, obviously there's bound to be competition, right?
Yep.
So can you give us a draw picture of the competitive landscape? Who are your major competitors who deal with the same product that you deal with, and how do you position yourself there?
Well, competition is everybody and anybody. My number one competitor is insurance company.
Why?
I'm trying to sell their product. They are my competitor number one. They still have 26% of the market where they go direct. So,
Right.
when I started this journey 25, 26 years ago, lots of people had said, "Hey, man, what India broking will never work, man. We deal directly." So there's the question, either we'll have our own sales force, we'll have our own branches. Broking India is not going to work. I think they've already been proven wrong. The fact that we have captured 37% share in less than 22 years. The first broking license was as in 2003, and we are in 2025 with just 22 years. So 22 years, this channel has got 37% market share. As far as country like India, for the size of the market, if you honestly ask me, competition is not a problem. Your problem is your own self. How good you are, what kind of team you are able to assemble, what kind of technology you're going to bring in. And if you invest in technology, you have a good, knowledgeable, caring, service oriented team, and you build an organizational culture that is customer centric. Trust me, competition is not a problem. There is growth, there is scope for everybody to grow. This, I'm saying this is going to be 5x market. This is going to be a 5x market. Today we are having 600, 700 brokers. The market needs 7,000 brokers. The market needs 7,000 players. What is the size of our country? And if we really have to do a job, it needs time, it needs investment to spend with customers, understand customer needs. So I don't see competition as a challenge. Yes, everybody has their respective space. Everybody is pursuing different strategies to reach out. You have MNC brokers who go after their MNC clients or very large, big clients with complex risks, multi-geography locations, etc. They need MNC brokers. You have all the automobile manufacturers having their broking outfit, taking care of their captive car sales, truck sales, motor vehicle sales, etc. There is a market space for them. There's a large corporate groups which have captive brokers for their group because the group is buying some 500 crores, 700 crores worth of insurance. And there are small, medium, tons and tons. If you ask me, the SME sector in our country is 80% uninsured. So if you ask me, competition, I say, where is competition? There's no competition. If you keep going and banging your head against the same wall, then there is competition. But please look for doors. Please look for windows. Don't look at the wall and break your head on the wall. Why do you want somebody snatch somebody's business? Go and build your own business, no? And customer need not deal with one person. For property program, he deals with one broker. For liability, he deals with another. For cyber, he deals with a third person. For life, he deals with another broker. So there's plenty of avenues for all of us to grow in this market. That's what I said at the beginning. We are fortunate to be an industry with a CAGR of 12 to 13%. I'm not in a business with 1% CAGR or 2% CAGR, where I literally have to fight with somebody to earn my bread and butter. For example, new insurance, cyber has become such a big thing. There are 683 brokers. Trust me, not more than 15, 20 can understand cyber insurance. The others can't sell cyber insurance. You focus on cyber. Now there is another new product that's come in. It's for bond insurance. Your performance bonds, bid bonds, security bonds market has opened up. Focus on that. It's again a niche area. Then there is mergers and acquisition insurance. Focus on mergers and acquisition insurance. There is a clinical trial insurance. Focus on clinical trial insurance. So there's plenty of stuff you can do. Or there's another thing called specie insurance, painting insurance, insuring painting. The big business.
Those high value paintings.
Yeah. Similarly, sports, event insurance, event cancellation. You have these concerts happening in every foreign artist wants to now do shows in India. The kind of money they make in India, they can't make anywhere. You had a sold out stadium in Ahmedabad the other day. Can you believe that? Huh?
Right.
Well, we are talking of India, Hindi, whatever regional language. There we are sponsoring foreign artists in English, and you have a stadium chock-a-block, man. So all these need insurance. So focus on these areas. So there's tons and tons of things which people can do. Satellites are insured. So plenty of scope in a growing economy like India. So I frankly don't see why one should get worried about competition. But as I said, there are plenty of brokers. Yes, we do compete, they do compete. But it is a question of the quality of service, the quality of relationship that you have, and the value add that you bring to the client will differentiate you from your competition.
Okay. Thank you for that insight and that understanding. We did not know that there are so many insurance offerings out there, niche offerings out there. Okay, so coming to my last question is, and feel free if feel like you don't want to comment on the other player, but Policy Bazaar is a prominent listed company,
Yeah.
and those guys have got the insurance license recently only, I think 2021, 2022, and those guys have scaled pretty well, right? After in just 3-4 years, they have created a very good positioning for themselves in the insurance broking industry.
Yeah.
So, what do you think has helped them scale to that level and gain, that kind of market share?
Okay, my answer to that is very simple. It's not that they're recent. If you can go back and check Policy Bazaar history, they've been also in business for almost more than a decade.
Right.
They were earlier web aggregators. They
Correct.
started their journey as web aggregators. They used to call clients, get the leads, etc., give the leads to the insurance company, and they were facilitating. Parallelly, they were into the money loan business, or what is called paisabazar.com also.
Correct. Awesome.
That kind of business also they had. So they had a retail reach out distribution business, and definitely they have pioneered the fintech or a tech platform where you could do B2C. They've done a fabulous job on the B2C job, where they have made the tool very responsive. They have invested tremendous amount of money in building the technology platform to be very responsive. They've invested tons of money in brand building. They have reached out to millions of people across the country. Today, I think Policy Bazaar is a word that is very commonly known, understood, and recognized by lots of people in the country, north to south, east to west. So that has taken tremendous amount of capital investment, and they've done a fabulous job in building a technology platform. And now they're also building the service platform to support the after sales service also. So all these factors have helped them reach the strong position that they have reached. They had the backing, they had the capital, they had the vision, and they've executed it well. So that's the reason why they are where they are. And do you want to say there can be have 10 more Policy Bazaars in India? There is potential for 10 more Policy Bazaars in India. If you can get your act right, yes, there is potential, and others are also coming on board. I don't want to take names. There are 4 or 5 other fintech companies which are also doing phenomenally well. So you will have quite a few more Policy Bazaars, and the market can take all of them. But you take the example of cement. Okay, there are how many cement producers? So there were plenty. Now there is some consolidation happening in the space. Similarly, insurance distribution, sooner or later, you will see some consolidation play happening in the insurance business also.
Possible.
So that's my view on what Policy Bazaar has done. A good job, and I'm sure they will continue to do a great job in future also.
That's all. So thank you so much. Thank you, sir, for answering all our questions. So before I'll go to the closing comments, I'll just give the disclaimer once again because it's very important. So all the information that is provided on this podcast is purely and purely for educational purposes. There is no idea of providing any sort of investment advice here. It's an open exploration of various businesses which exist in India and that we believe should come in the eyes of all the business enthusiasts which exist out there. So please be informed that this is not an investment advice. This is purely an educational episode which you are watching. So with that, Ramakrishna sir, it was indeed a pleasure talking to you. Thank you for patiently answering all our questions in an elaborate way. We hope we have not taken up too much time from you, but
no problem.
it was a pleasure speaking with you. Thank you so
Same
much.
here, please.
Thank you so much.
All the best.
Thank you so much, sir. Wish you all the best for the business, and thank you for being a part of Made in India.
Thank you.
Thank you.